Something huge is happening in the global gold market. The system that's been in place for decades, well, it's starting to crack, and the people in charge are getting very, very nervous. Let's get right into what's going on.
Panic in London. That's the core message coming from financial analyst Mike Maloney. He's making the case that the London Bullion Market Association, or LBMA, that's the group that has basically dictated gold and silver prices for generations, is now visibly and rapidly losing its grip. And this, of course, leads to a pretty big question. According to Maloney, the Intercontinental Exchange, which hosts the official LBMA price fix, has actually banned him from displaying their data. He compares it to watching a suspect shred evidence right before a trial. The implication here is pretty clear, isn't it? It kind of screams they have something to hide. So what is it that they really don't want us to see? To understand what they might be trying to keep under wraps, make sure you subscribe for more breakdowns just like this one.
Okay, so let's look at the core evidence that Maloney presents. This is the data he claims shows how the real price of gold has been distorted for decades. Now, this is just wild. Look at this disparity. Since 1971, if you only tracked gold's price during London's trading hours, it would have barely moved at all, from about $35 to just $224. But, and this is the real kicker, if you take London completely out of the equation, that same ounce of gold would be worth nearly $50,000. The argument here is simple. This is no coincidence. It's evidence of consistent downward pressure on the price, but only when London is at the controls. And this gets us right to the heart of Maloney's thesis. He calls this suppression, but here's the twist. He doesn't just see it as a problem. He actually frames it as a massive, historic investment opportunity for anyone who understands what's really happening. Now let's jump to 2022, because this is where the story takes a really dramatic turn. A major geopolitical event seems to have completely broken a financial relationship that had held true for decades on end. You see, for years, the gold price was incredibly predictable. It moved in almost perfect opposition to real interest rates in the United States. When real rates went up, gold went down, and vice versa. This relationship was so tight it had a statistical correlation of 97 to 98%. It was basically a fundamental rule of the market. But then, in early 2022, that rule just stopped working. The lockstep correlation completely shattered, and gold started moving totally independently of real interest rates. Something fundamental had changed the entire game. And this right here is the trigger. Maloney points directly to the moment the U.S. and its allies seized Russia's foreign currency reserves. He argues that this one act put every central bank in the world on notice. Their paper assets, their dollars, their bonds, they could be taken away at any moment. Trust was broken. And that, he says, is when the global rush out of paper assets and into physical, sovereign-owned gold really began. And what's so fascinating about all this is that this analysis isn't some fringe theory anymore. The biggest, most influential names in traditional finance are now echoing these exact same ideas and repositioning their strategies because of it. Take Jeffrey Gundlach, for instance, the so-called bond king. This guy is a titan of the traditional bond market, and he's now on record saying that a 25% allocation to gold in a portfolio isn't excessive. Coming from a mainstream financial heavyweight like him, that is a massive shift. And it doesn't stop there. JPMorgan, one of the most powerful banks in the entire world, is now recommending its clients allocate a massive 20% of their portfolios to gold. Now, if you look deeper at their market view, this recommendation becomes even more significant. They're telling clients to go long on gold and silver, while at the same time shorting assets like oil and industrial metals. A strategy like that sends a crystal clear signal. They are anticipating a major economic contraction, and they're positioning precious metals as the ultimate safe haven. And it's a similar story over at Morgan Stanley. They're advising their clients to ditch the traditional 60-40 stock and bond portfolio. Their new recommendation, a 60-20-20 split. That means slashing bond holdings in half and moving that 20% directly into gold. When Wall Street's biggest players all start making the same move at the same time, it is absolutely time to pay attention. To keep up with these huge shifts, hit that subscribe button right now so you don't miss our next breakdown. So this all builds toward the central metaphor that Mike Maloney uses to describe the current situation and what he believes is the inevitable outcome. He calls it the coiled spring. And the idea is pretty simple. For decades, artificial pressure has been pushing down on the price of gold. But you can't suppress a market forever. The longer and harder you press down on that spring, the more potential energy gets stored up. And when that pressure is finally released, the upward recoil isn't going to be gentle. It's going to be explosive.
The evidence suggests the system is breaking down and that spring is beginning to snap. This really leaves us with one powerful question. Are you positioned for the recoil? As the old financial rules give way to new realities, understanding these massive shifts is more critical than ever. For more explainers that cut right through the noise, make sure you're subscribed and have notifications turned on. You won't want to miss what's coming.